Hello, everyone. Welcome back and a happy 2026 to you. Happy New Year. As I keep saying, it's mid-January, and who cares what Larry David has to say on this topic? We are still wishing everybody a happy New Year. And we're doing so. We're kicking it off this year with Horizon Investments, Austin Fitch, Head of Consulting Solutions for Horizon Investments. Austin, welcome back. Thanks so much for being here. I think one of the best things about these recordings is the fact that we're so steady in delivering them, and your smiling face is waiting for us so many times on these recordings.
No, happy to be here, Lou. Excited to jump into the conversation, and same to you. Happy New Year, man.
Thank you so much. And we will jump into the conversation. And as always, no charts, no graphs, conversation between Austin and I. And about 18 minutes we'll take today. So I think we'll hop to it. And I'm going to start with 2026, beginning where 2025 started, a conversation about the Federal Reserve being under attack again, and its independence being under attack. What I would like for you to do, Austin, if you would, explain. I'll say again, but it's an update, we'll say, to the conversation. Why is it bad that the Federal Reserve is under attack? And give us, what does it mean should it become politicized?
I would say, should it become politicized? I think it's become obvious. Maybe it already has. But I would say this. So the Federal Reserve becoming politicized or coming under attack, we actually talked about it. We talked about it a lot here at Horizon. That's probably one of the, if not the biggest risk to markets as we look out into 2026. And the irony here is that you've got a president, you've got an administration that wants lower interest rates, which I think collectively, as maybe from an economic standpoint, you can understand the desire to help drive economic growth, right? Lower interest rates oftentimes lead to more capital projects from companies. Again, I think we've talked about the fact that with Trump's real estate background and development background, he understands the power of lower interest rates from an investment standpoint, from a like I said, from a project starting standpoint. But the irony is that if the administration, if President Trump specifically wants lower interest rates, the last thing that he should be doing or that he should be thinking about doing is really getting in the way of the Fed kind of doing their job and politicizing the Fed. The reason being is history would tell us that any time that a kind of an administration has really wrestled with a central bank, the outcome has been the same every single time. It leads to lower currency values. So think in this case, a depreciating dollar, a weakening dollar. And just the way that kind of the bond math works, anytime you get a depreciating currency, it leads to higher interest rates. So him coming out and really pounding the table, to some extent pushing, in this case, Chairman Powell, for lower interest rates, really would likely have the opposite effect. It would also lead to kind of a questioning, if you will, across the broader marketplace around the independence of the Fed. It would probably lead to a questioning of, if you think about just kind of the U.S. economy as the backstop of the global economy, whether or not that continues to be the case. Like all of those things are things that come into play as you talk about politicizing the Fed and the Fed coming under pressure. Again, that is probably the biggest risk. We'll talk a lot about, some of the tailwinds that we think are coming and really at the back of the economy and the market. But if you want to hit like the biggest risk as we head into 2026, that one is front and center.
And it seems to be self-defeating. I mean, you just mentioned that in so many words, that it's a self-defeating practice. So is it just a matter of, not liking Jerome Powell? What is it? To me, and I've had conversations with clients that have made, we'll say, different statements than this. Jerome Powell has been excellent through COVID. This Fed in total, have they been perfect? The answer is absolutely not.
Right.
And I would defy anyone to go back in history and find the perfect Fed.
Right.
that hasn't been called imperfect after the fact.
Correct.
Okay. And,
Correct.
that includes Alan Greenspan, who everyone credits with updating the Fed and their policy and their method of operation. Really, the person that moved the Fed front and center, that where we're actually waiting to hear what they have to say. Because again, when I started this work 34 years ago, which I can't believe I get to say that, when I started 34 years ago, it used to be that there would be it wasn't even an email at the time.
Yeah.
Okay.
Yeah.
It was just, you'd read in the newspaper.
Came across the newspaper.
The Fed holds
ticker tape,
rate steady, and everybody moved on. No one had a word to say about it. So what is the point? And if you would, because you brought up the fact that it's the biggest risk to the market, we had a really nice 3-year run. So we'll save what we were looking at in 2026. What would this be in Horizon's opinion, the stopping of a fourth good year in the stock market if the Fed truly is?
If you really had President Trump, the current administration, going after and essentially forcing the Fed to lower rates further than they otherwise would, again, I think it calls into question the whole idea of independence of the central bank in the U.S., which is not a good position to be in. And again,
why does it matter?
Yes.
Why does the Fed matter? That is the response that I have heard. Yeah, come on now. We're professionals here. You can't chuckle about that. Why does the Fed matter?
Yeah, I mean, I would say it this way: the Fed is there, obviously to set interest rates, right? That's one of their main jobs, and to monitor labor markets. Like they have kind of a two-prong mandate, a dual mandate, right? And if you think about it, they're there, and we kind of saw this in 2020 to some extent, and coming out of 2020, like their role in a catastrophic scenario is to create stability. Now we could sit here and argue whether or not like sometimes they increase volatility and to some extent do the opposite. But at the end of the day, if things are falling apart, the Fed is oftentimes seen as kind of that backstop. And for those kind of capital market purists out there, again, we've had a lot of conversations with folks post-COVID to say, well, if the Fed didn't step in, you would have had kind of a cleansing, if you will, of the marketplace, and that's not necessarily untrue. If there wasn't a Fed in 2020, what would have happened? It probably would have been a lot deeper in terms of the pain, but maybe it's cleaner coming out. This is one where like playing Monday morning quarterback is I guess easy and you can have those conversations. When you're in the thick of it, the ability for somebody to step in and kind of, hey, we've got it under control. We're going to kind of come in and stabilize everything that's going on. That's essentially what they're doing, both from an interest rate and a labor market perspective, or at least that's their mandate. Again, we can sit here and debate whether or not that's necessary 95% of the time, but that's like if you really boil down to it, that's what they're there for.
Thank you. And I'm going to summarize as I hear it in my head. I'll share it with others listening. They're in place to take these measures, to be the backstop, and to do so without concern whether American people identify themselves politically as Democrat, independent, or Republican. Correct. It is supposed to take that away. Yep. Because in the current administration, we'll say the dominance of the current administration, there are a large swath of people that would be negatively impacted if it was done the way, let's say, because it's Republican dominated right now, the Republicans want to do it and would see it as wrong that it's political. So, and they're, by the way, anyone who sees it left, right, center as wrong, politically incorrect, to have them to be politicized. How's this? They're right. Okay, those are the people that are correct. It needs to be independent. All right, let's leave it right there. That's that. You did get the official Tranquilli comment on that. It needs to remain independent. All right. Horizon's outlook in 2026 for stocks, and you don't have to give us a prediction on the returns or anything like that. I will say this, and everyone watching can go back and find the January of 2025. Austin, you were bold in your comment about potential returns in 2025. And I have to, of course, say well done on your part. We won't bring any numbers up because I don't want the SEC crashing through the door. So, but you had a good year that way. Tell us what Horizon sees. Let's remove the Fed as part of the equation and say it stays as is. There's a lot of noise about it, but it stays in its current
That's
format.
what I was going to say. If we take the Fed out of the equation and say, hey, at the end of the day, it doesn't end up being nearly as politicized as maybe it potentially could be, or what have you. I think our view on 2026 is that there actually remain a lot of tailwinds in the marketplace, but there's a caveat to that to some extent, that the tailwinds are starting to broaden out. And why is that important? Well, that may mean that the Mag 7 don't necessarily lead the market higher in 2026. And that's not to say that the Mag 7 or those large cap growth companies are going to have a terrible year and fall off a cliff. They may just return to normal, right? They may be up 6, 7, 8, high single digit percent. Which again, for anybody that pays attention markets long term, markets on average return somewhere between 8 and 10% over the long term. Right. If that's the case and you get a Mag 7 that returns to that, then maybe you get small caps, maybe you get value companies, maybe you get mid cap companies, maybe you get other areas of the market that haven't participated in the run up nearly as much as some of those Mag 7 names, really starting to see kind of this kind of flow through effect from much of the CapEx investment that we've talked about in the past. This AI infrastructure that we've talked about, maybe that starts to flow through to smaller cap companies. And if you get that, generally that would be a good year for markets. But at the headline, it may not look nearly as high because of the Mag 7 kind of overweight in many of those index names, if that makes sense.
Makes perfect sense. And again, to summarize, the outlook is we are seeing more of the stock market participate in the recent positive returns, moving away from a concentrated 7 technology stocks that have driven it for much of the last we'll say up until the beginning of 2026 here, for about 18 to 24 months. We've had somewhere between 5 and 7 stocks in the S&P 500 generating the return. Which is absurd. And at one point, those 7 securities made up 30% of the value.
Yes.
And even higher than that at one point, if I recall correctly. And that is according to Bloomberg. And I'm using memory there, but we'll cite Bloomberg on that. So the danger of the stock market, we'll say, is always real and was very concentrated to these 7 securities. I'll be an investor for a moment. So what? It went up. Why would I worry about that? Well, I would say again, and it's not. It's nice that I've been doing this for 34 years, but now that's the second time I mentioned it. With 34 years under my belt, the fact that it could concentrate so deeply in these 7 securities is a dangerous moment for stocks. We're past it, is what you're saying. We're looking at a broadening of the stock market.
You're starting to see. You're starting to see like a diffusion. Like, I know we've talked about this AI theme a little bit in the last couple of quarters. Like, who you've seen benefit from this AI theme and this infrastructure, like AI infrastructure investment, and like who's benefiting on the ground floor has been those Mag 7 technology focused names, right? The question that we've had and the conversation we've had here at Horizon is, for this AI theme to really become this transformational technology that I think a lot of us think that, it could be, that you have to see this broadening out, right? You have to see small cap companies really take it and run with it and become more efficient and drive profitability to the bottom line, right? You have to see value companies that maybe otherwise you don't think of front and center from an AI conversation. Like, you have to see that impact there. And our view is, I think you can, That's what drives growth in 2026. It's not NVIDIA just goes higher and higher forever and never, amen.
Right, right. Okay. So I did not prepare you for this question at all. I'm going to throw it out there. Why am I reading, hearing, talking so much with other investment firms about looking outside U.S. borders for growth? Why are we hearing that? I am going to stand up for a moment, so pardon me while I do so.
No, I think you're hearing a couple different reasons for that. One, and it started in 2025, was you start to see kind of this weakening of the dollar. And that just makes investment outside of the U.S., exporting outside of the U.S., makes it a little bit easier, makes it more attractive. So I think you get probably this weakening of the dollar continuing. You probably don't get it to the extent that we got it in 2025, especially the first 3 months of 2025 when the dollar really came under pressure. But if you get, again, even just a marginal weakening of the dollar, that helps international stocks. Additionally, like if you think about kind of that broadening out theme, it actually holds the same argument holds if you think outside the U.S., right? Think about companies outside of the U.S. and some of that CapEx investment, some of that infrastructure investment, some of that AI conversation. A lot of folks maybe don't realize this. A lot of the tech sector globally is concentrated entirely in the U.S. and a very specific few names in Asia. Like it's really not in Europe. It's not in a lot of, really, it's not many other places in the world other than those two specific locations. And with that being the case, that means if you get this diffusion of efficiency and profitability gains outside of those 7, 10, however many names we're talking about, all of a sudden, it's not just the US, it's Europe, it's emerging markets, it's again, maybe other Asian countries potentially. Like you have that opportunity for investment outside of the US that maybe, again, you haven't had over the last few years when everything has been focused on such a small number of names.
Excellent. Thank you for that. And we will continue to look outside U.S. borders for that growth because as Wayne Gretzky's dad said, we're looking for where the puck is going, not where the puck is, kind of thing. So last thing, and just give us a couple of minutes on this, please. Planning, preparation. We've really put the concept out there to our clients, the people that we're talking to, they become clients and family members, that we are more about the preparation than the prediction. And I think these videos, the emails that we send, these conversations that lead into this, how is Horizon planning for 2026 within portfolios? How are you managing the risk between, let's say, the Fed, which you've identified internally as the biggest risk, and this continued broadening of the U.S. stock market and the potential to look outside U.S. borders for growth? How is Horizon managing that?
Yeah, I think one thing I would say, Lou, is kind of at the core of who we are as an asset manager is the ability to be flexible and to be tactical. Whether that's through just managing the underlying components of a portfolio, right? Do we make the decision growth, value, large, small, domestic, international, right? The ability to like pay attention and make changes and not just say, hey, here's our view on 2026 and we're going to hold it, for the year, regardless of what happens. So that's one thing. The other piece that Horizon offers is that risk mitigation, the component where, hey, we've identified some potential risks. We're not saying that those are, imminent today, but should they play out, right? Having the ability to protect that downside, we call it risk assist, but having some form of risk mitigation, we think is important for a lot of folks in their financial plan. And I would kind of even take a step back and say, I think you kind of alluded to it. Our view, just as asset managers, is we can sit here and talk markets and talk asset allocation and investment philosophy. But at the end of the day, for clients that are watching this video and working with you, having a financial plan and more importantly, sticking to that financial plan is infinitely more important probably than anything we're talking about today when it comes to their decision making. Because working with a financial planner like yourself is what allows them to, one, be invested in hopefully the right portfolio for whatever their goals and objectives are, but sticking to that through the ups and downs of the market, through that market volatility, having a portfolio that can maybe protect them on the downside if they need that, that keeps investors from making decisions that they would otherwise come to regret and take them kind of off track from a planning perspective. I would argue that's as important as me sitting here telling you that Horizon is able to switch from growth stocks to value stocks when the market dictates.
Well, and there is an excellent study out by Vanguard, no less, of the value of a financial advisor. And I appreciate you getting to that point. This was not supposed to be an advertisement, but we'll take it. Okay. And for everyone that's listening, either on single speed or double speed, we talked about that earlier. The reason Tranquilli Financial Advisor gets along with Horizon Investments is the ability to have these conversations, have some input, and the willingness of Horizon and Tranquilli Financial Advisor to not sit on our laurels and say, "Wow, we've really had that correct. Doesn't that look great?" Okay, or rest on our laurels, however you want to put it.
Yep.
And we will upset the apple cart if we think that's the right thing to do, and that's I think good for both of us. The fact that we can have open communication, it's here to be to the benefit of clients. We're not perfect. We've said that already in this video, but it is good practice to prepare rather than be purely predictive or just saying, well, we've gotten that right in the past, we'll get it right again, kind of thing. So Thanks for that, Austin. Thank you for just about 20 minutes or so. Yeah. Austin Fitch, head of consulting solutions, Horizon Investments. We'll do it again this, let's say the second quarter of 2026. How about that?
Let's do it. Sounds good. Appreciate it, Lou.
Thanks so much. Good to talk with you.
See you guys.
Bye.